Increasing equity. Equity is most often increased in two ways. Profit. As a business generates profit over its history, the total cumulative profits and losses over its entire time in business are added to its equity. Selling shares. When a business sells stock or shares in the business, which means ownership in the business, those who buy the shares give the money to the business, and this money is recorded as equity. Equity is reduced if the business suffers losses, which are negative profit, or if the business issues dividends to its shareholders, its owners. A dividend is simply a share of the profits, which are shown as equity. Profit, retained earnings. Profit increases equity. For example, if you make or buy 100 widgets for $5 each and sell them for $7, you will make a profit of $2 per widget, as shown in this table. This assumes there were no other expenses incurred with buying and selling the widgets. So if you buy 100 widgets at $5 each for a total of $500 that you've spent to buy them, but you've sold them for $7 each, all 100 of them, for a total selling revenue of $700, 700 minus 500, you have a profit of $200. The $200 profit shown gets added to the equity on the balance sheet, as shown in this table. Notice that before the widgets were purchased, you have $1,000 in cash. Then $500 is used to purchase the widgets, so cash is reduced by $500, and widgets are added as an asset that you own. Then the widgets are sold for $700, that is added to cash, and the widgets no longer appear as assets because they're now gone to customers. You no longer have them. So at the end, you have $1,200 in cash. That's more cash than you started with because you sold the widgets for more than you purchased them for. And your equity is $1,200. So you've increased your equity by $200. Profit is the most common way that businesses increase equity. Profit is tracked on the income statement, or the profit and loss, or P&L as it's sometimes called. The profit, or more specifically, the net profit, at the bottom of the income statement is added to the equity on the balance sheet. Profit is added under equity as what is called retained earnings. Selling shares. When a business sells stock or shares in the business, which means ownership in the business, those who buy the shares give the money to the business, and this money is recorded as equity. For example, let's say you sell a certain number of shares for a total of $500. The new shareholder gives your company $500 cash, and you record this transaction on the balance sheet by increasing cash by $500 and increasing equity by $500. Money gained through the sales of shares is not considered profit and does not appear on the income statement. It only appears on the balance sheet. Notice that the balance sheet equation still remains in balance. Assets minus liabilities equals equity. So before we had $1,000 in cash and $1,000 in equity. Afterwards, after selling the shares for $500, our cash has increased by that amount to $1,500, but so has our equity. BusinessXP is the fastest and most inspiring training ever invented for future business leaders and entrepreneurs. Discover game-based experiential learning at business-xp.com.